Hello good people, hope you're doing well. In today's video we are going to talk about unit trusts. What do you know about unit trusts? Comment down below. Welcome to another episode of Live, Learn, Adventure and Charity, where we talk about finance, personal development, travel and community service. If this is your kind of content, kindly subscribe so that you're notified every time we upload a new video. So, on today's topic, unit trusts. What are unit trusts? Unit trusts are investment schemes that pool resources together to be able to multiply the resources for the investor to grow the funds. I'm going to read the detailed meaning. Unit trusts are investment schemes that pool money from various investors and are managed by professional fund managers who invest the pooled money in a portfolio of securities such as stocks, bonds, and other money market instruments or other authorized securities to meet the objectives of the fund. The pooled resources earns income in form of interest, dividends, and capital gains. If you are considering short, medium, and long-term investment, this is one of the ways you can invest. In simple terms, unit trusts are investments where different investors' funds are pooled together to be reinvested so that the investors can get returns. Comment down below if you have invested in unit trusts. The first fund is money market fund, where your investments and your funds are invested in short-term debt securities like bank deposits, treasury bonds, and commercial paper. Money market is best for risk-averse investors because it poses a low risk, and of course when we talk of low risk, it also means that the returns are low, but at least there are returns. The next fund is equity fund, where your money is invested in public listed companies under the Securities Exchange. I actually wanted to say Nairobi Securities Exchange, but remember it could apply to different countries. So let's refer to it as Securities Exchange for today. The aim of this fund is to grow your funds and you get returns through dividends, and obviously your capital will grow. This is a high risk and it is usually for medium or long-term investment, and most likely you may want to recall it maybe when the rates are high when you grow, because it's also it is also a reasonably high risk. So you want to be careful when you're trading with it, especially if your risk appetite is low, but it can also give you growth. So I think it is important to balance your investment. Of course, you have some risk averse aspect and risk appetite so that you don't put all your eggs in one basket. The next one is fixed income funds. These are invested in short-term debt securities like treasury bonds, treasury bills, and corporate bonds. The returns on this investment is capital growth, of course, and you also get interest in return. This is also a low-risk investment. It is attractive to people who are risk-averse. The next one is balanced fund. This has diversified investments. They can either be in equity or fixed funds. And this also, of course, is more or less balanced because the risk is shared between equity and fixed. Remember, we said equity is high risk and fixed income is low risk. So it's like spreading your risks. So perhaps if you do not want to individually diversify into the two, you can consider a balanced fund. Why should you invest in unit trusts? Number one, they are professionally managed by a fund manager of fund managers, and therefore they will always be accountable for your funds. Your investment is safe because for the risk averse, of course, they are automatically safe. And the ones which have a risk, like the equity, the market is regulated by the Capital Markets Authority in the case of Kenya. Perhaps if you're not in Kenya, you can comment down below which body regulates your equity fund. The next thing is attractive returns. Sometimes the high risk gives you high returns. Sometimes they are really low that you don't even want to call them up. But in most cases, you'll find the returns are high. Even for the risk averse, like the money market, you will still get some returns. The next thing is liquidity. In most cases, you can be able to access your funds within at most 48 hours, and sometimes even a shorter period, like within even less than 24 hours. So then it's very liquid, but it also helps you manage your discipline, because if, for instance, you had your money in your current account, or maybe in your M-Pesa, you can easily withdraw and do your transactions. But if your money is invested like in the different funds, then you need like at least maybe 24 to 48 hours to access the funds. And if you're not getting the funds for a productive investment, sometimes it helps manage your expectation, and it also helps you reduce withdrawals because you feel guilty every time you withdraw. The next benefit is you get an advantage of experiencing different options. For instance, maybe you may not be able to invest in the listed companies, but through the unit trust you're able to do that. It helps in your investment planning. I would like to put a disclaimer. One, you need a very good fund manager to be able to maybe grow your funds, someone who is up to date with where to get what and how to effectively grow your money. And number two, you ensure you're dealing with an expert who will be able to guide you through the process and who will help you understand end-to-end process, and who will walk with you the journey. Don't think because you have watched a few videos or you have heard from friends and relatives, now you're ready to invest in unit trust without seeking advice. It is very, very important. And also, it is a very good ticket for a first-time investor. You can start your investment journey using the unit trust. Of course, anything with an advantage has disadvantage. Some of the funds may be very risky and you may end up losing money, but some of them are risk-free. And although, of course, like we said, the lower the risk, the lower the returns. So expect low returns, but your money is safe. On the other hand, if you have some risk appetite, you can easily grow your fund. The next thing is costs. For you to hire a fund manager, it means you're going to be paying them for the service. So that will be another cost to your investment. But if your investment is giving returns, then it means it's actually paying for itself. The next thing is that you don't have control and you have entrusted someone to do your investment for you. So sometimes you may think maybe you want to try something else, but because you're limited to this particular investment, it becomes difficult for you to move. But remember, you can always diversify. You're not stuck on one mode of investment. Of course, there's capital risk. For the investments that we have said that you're going to be investing in equity or listed companies, then it means maybe your capital may depreciate instead of growing. Yeah, so thank you so much for watching this video. If you're new, kindly subscribe. Why do you subscribe? So that every time we post a new video, you're notified, and ensure the notification bell is on. And also, you can be able to share your feedback as to the kind of videos you want us to share on this on this channel. Remember, this channel is all about you and us. We value your feedback. So if you would like us to share any topic, please comment down below and ensure your notification bell is on so that every time we upload, you're notified. See you on our next one. Bye.